Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Israel and Hamas agree to a ceasefire. It will begin on Sunday and last initially for 6 weeks. The deal includes the release of 33 hostages, while Israel will withdraw from populated areas of Gaza. Risk on returns. Cooler US inflation sparks a global rally, with Asian stocks tracking gains on Wall Street. In Japan, Bloomberg understands BOJ officials see a good chance of a rate hike next week. We bring you our scoop. Plus, earnings season gets underway as TSMC posts a big beat on net income, and 4 of America's biggest banks see their second most profitable year in history. We look ahead to the numbers from Morgan Stanley and Bank of America later today. We talked about the bank earnings story. We have earnings coming through from the luxury group Richemont right now, with third quarter sales at a constant FX level up 10%, well above the estimates. This is a stock that is up around 35% over the last 12 months, where the jewellery division has been relatively resilient to the slowdown in luxury spend in China. China, of course, in focus for this company. Watches, that division has been under pressure, but it's a beat in terms of the earnings that have come through, the sales numbers for the third quarter. Just breaking it down in terms of the top line number, then we'll go regionally. Sales for the third quarter coming in at 6.15 billion. The estimates had been for 5.64 billion. There's the significant beat then in terms of sales. Over 6 billion euros of sales in the third quarter. The estimates had been for 5.6 billion euros of sales. In the Americas, revenue was up 22%. In Japan, you saw a gain of 19%. And in Europe, a gain of 19% as well. Well above the estimates in Europe, where you'd seen an expected increase of 6% in terms of revenue. The actual number coming in at 19% as the increase in revenue for Richemont. This will be a stock to watch at the open at 8 a.m. UK time. Pun intended, of course, the jewellery and watchmaker. We're also getting numbers we expect in terms of Renault sales as well. Group vehicle sales for the French automaker up 1.3% versus 2023. We keep an eye on Renault as well. That stock is, of course, one that's been questioned. It's actually up around 48% over the last 12 months because the broader challenges for the auto sector in focus. But you're seeing vehicle sales up 1.3% for Renault and that group versus 2023. That's a year-on-year number for that company. Let's get to the markets right now. It is risk on, given the soft CPI print we had out of the US yesterday. Yields on the 10-year dropped about 15 basis points. To what extent will this be a prolonged headwind then, or tailwind, I should say, for the equity space? European stocks actually taking a breather after rallying more than 1% yesterday. Again, on the more benign picture in terms of inflation out of the US. European futures now pointing down by 0.3%. FTSE 100 futures, meanwhile, pointed to gains of 0.1%. S&P futures, after the strong gains that came through yesterday, currently flat. The S&P rallying 1.8%. Nasdaq 100 looking to lose 32 points after gaining 2.3% yesterday, the biggest rally since Trump's election. Let's flip the board and have a look at what is happening in Asia, because the handoff is there in terms of the gains that have come through broadly on the MSCI Asia Pacific, up 0.8%. The CSI 300, though, on mainland China, looking for the next catalyst there, currently flat. The Nikkei in focus on the Bloomberg reporting around the BOJ looking potentially to hike next week. The Nikkei currently up just shy of 0.2%, and the Japanese currency in focus, gaining 2 cents in the session versus the US dollar at 156, again on that Bloomberg reporting. Cross asset, let's flip the board. We saw that big move into treasuries yesterday. Of course, yields came down. Has the bear market around the global bond sell-off come to an end, or is this temporary reprieve in terms of government borrowing costs? 4.65 right now in the 10-year. The pound continues to be in focus, under pressure again in the session today, down 0.2%. We did have a better picture when it comes to inflation yesterday out of the UK, of course. 122 on the pound, Brent $82 a barrel, and Bitcoin closing back in on 100,000 at 99,383, benefiting as well from expectations that the Fed could cut, fully priced now for July. Currently, the cryptocurrency down 0.3% in the session. Let's get to geopolitics, though, because Israel and Hamas have agreed to a ceasefire deal in Gaza. It pauses 15 months of fighting that has killed thousands of people and caused widespread destruction. The three-phased element, an agreement, will take effect on Sunday. It includes the release of 33 hostages held in Gaza and Israel's withdrawal from populated areas in the Strip.
700 days of failure and 1 day of success. Well, we've had many difficult days since Hamas began its terrible war. We've encountered roadblocks and setbacks. We've not given up. And now, after more than 400 days of struggle, a day of success has arrived.
Let's get more with Bloomberg Horizons anchor Jemana Besetchi. Jemana, what more do we know about the deal? How confident can we be that it will actually take place on Sunday?
Well, the deal is done, which is a very positive step for the region after more than 14 months of conflict and many false starts. As we know, there had been several rounds of negotiations over the course of the summer, several false starts, and we thought we were close to getting a ceasefire deal towards the end of the summer last year. And of course, that all massively reversed. But now there is a deal that has been agreed to, as announced by the U.S. and by Qatar yesterday. The Qatari Prime Minister, the Qataris playing a huge role in these mediation talks, making a statement yesterday to the effect of what the deal actually contains. Now, it's important to note here that what has actually been agreed to is phase one out of a three-phase ceasefire plan. So phase one is known as the humanitarian part of the ceasefire deal. It will entail the release of 33 hostages being held in captivity, some believed to be thought dead, in exchange for Palestinian prisoners. It would also allow for the passageway of aid into the Gaza Strip, much needed, with about 90% of the population facing acute food poverty. It will also entail Israel forces moving away from the central part of the Strip towards a buffer zone and allow for the internal movement of displaced Palestinians from the southern part of Gaza back into the northern part of Gaza. So all of those elements have been agreed to. Now, the more challenging part is what happens next and how you transition from phase one to phase two, which is a more permanent ceasefire and the release of the rest of the hostages, the male hostages, in exchange for even more potentially and again, very contentious topic, the release of Palestinian prisoners from Israel as well. How we get there is going to be a big question, and whether or not Israel are willing to offer further concessions in terms of the withdrawal and how much presence they want to maintain in the Gaza Strip is going to be a subject of discussion. But they do say by the 15th or 16th day of phase one, they need to start talks vis-a-vis phase two. What we do know, Tom, is that phase one is going ahead. This marks the end of bloodshed, but possibly not the end of the conflict.
Jemana, incoming President Trump, he's kind of taken claim for getting this deal across the line. How big a role did he and his team actually play in this agreement?
Well, you could say he actually played quite a big role. And back in December, you may recall that Trump said, and he said this, all hell will break loose if the hostages are not returned back home before he steps into office. He's obviously stepping into office in a couple of days' time. And so it has been a big focus of his. He has said consistently, even on the campaign trail, that he wanted to see this deal done and dusted before he stepped into office on January the 20th. So in this past couple of weeks, we've seen a bipartisan push. It has not just been the Biden administration negotiators, the Secretary of State, Anthony Blinken, Jake Sullivan in the region pushing the discussions, but also the Trump Middle East envoy, Steve Witkoff, came to the region as well. He met with Qatari officials, but then also with the Israeli Prime Minister Netanyahu himself on the day of Sabbath. And he came with a very strongly worded message to the Israeli government, saying that Trump, under no conditions, no situation, wants to see this ceasefire talks or discussions being dragged on any further. And so it certainly does appear as though the Trump administration did give that extra push that was needed to get it across the line. Now, it also is relevant because if you want to think about the longevity of the deal, it is very important that the U.S. continue to support what is going to happen vis-a-vis phase two and phase three. And the fact that the Trump team feels some ownership towards it suggests that Trump will have a vested interest in the deal being successful.
OK, Bloomberg Horizons anchor Jemana Pasecci on this historic deal with questions that still remain, of course, as we look ahead to Sunday and the first part of that deal coming into place. Jemana Pasecci on the ground for us, covering all of that in detail. Now to the macroeconomic policy, switching focus right now, because the December reading of US inflation rose by less than expected yesterday, igniting the best CPI day for the equity market since 2023. The core consumer price index increased 0.2%, marking the first step down in 6 months. Chicago Fed President Austin Goolsbee says he's optimistic about taming inflation without sparking an economic downturn.
The trend continues to be improvement in inflation. I'm still optimistic for 2025 that we can continue growing and have a soft landing.
OK, for more, let's bring in Bloomberg's Valerie Titel. Valerie, so we're hearing there from Goolsbee on a soft landing scenario for the US economy. How have expectations around the Fed's next steps altered and changed in light of the inflation data we got yesterday?
Tom, there is a lot of market optimism out there that the Fed's easing cycle isn't done just yet. That cool CPI reading really igniting this optimism that we could still see those 2 Fed cuts during 2025. That is the Fed's base case. There is some speculation out there that that could come again as soon as March. It's going to put to bed the fears that the Fed would raise rates this year, at least for now. But it ignited a rally in the Treasury market, as well. Those yields coming down near a double-digit basis point move in the Treasury market. That bond rout is over at the moment. It did ignite an even further rally in the gilt market. Those fears about the UK government being put to bed for now. But looking ahead, at least for the Treasury market, we have those U.S. retail sales numbers coming at 130. We also hear from the Treasury Secretary pick from Trump, Scott Bessent. He has his Senate confirmation hearing later today. We did get his statement pre-released where he said that Trump has a generational opportunity to unleash a new economic golden age for the U.S. He warned that that the U.S. should protect its critical international supply chains, and he did critically back up that the U.S. needs to protect needs to ensure that the U.S. dollar remains the world's reserve currency.
But we also have the Bloomberg scoop around the BOJ's thinking ahead of its decision next week and seeming to edge closer to another hike.
Yeah, we've seen the yen have 2 days of strong gains, now at its strongest in over a month. Now that Bloomberg scoop on the Bank of Japan says that this good chance of a January hike would come if the markets are calm heading into the Bank of Japan decision. The Bank of Japan's decision is next Friday, so 5 days after President-elect Donald Trump takes office. So as long as we have some calm markets during the week next week, that Bank of Japan hike on that Friday does seem a bit likely.
Valerie Titel, thank you very much indeed. Yep, the yen strengthening on the back of that story. Another big decision, of course, for the central banks next week. Looking, though, through the market context on the back of that inflation data that came in softer, of course, for the US as well. Valerie Titel, our markets reporter, thank you. Turning to earnings news, TSMC's profit in the December quarter topped estimates with a 57% rise. The earnings call has just kicked off. Bloomberg's Annabelle Drulas is tracking all of this for us. Annabelle, another strong picture in terms of the numbers coming through for TSMC. It seems a lot of that is driven by that AI demand. What stands out to you in terms of the numbers that we've had from this company?
Well, what's really standing out, Tom, just in the last couple of minutes is we've got the earnings call that's just kicked off and we're hearing about the expectations for the first quarter, and they're strong, which is great news, of course, for anyone that's invested into this AI theme. But talking about the numbers themselves, so first quarter sales are expected to be between $25 to $25.8 billion. The estimate had been for $24.43 billion. Gross margin as well. This is seen being better than expected at 57 to 59%. The estimate had been for 56.9, and put it in context as well, because TSMC's longer term expectation around the gross margin is for it to be around 53%. So even by their own metrics, they're doing better than expected. It goes back to really that growth story, because when you drill down into the fourth quarter numbers as well, which you said came in better than expected and a huge revenue rise on the year, 3/4 of their revenue is coming from 7-nanometer chips and above, so their most advanced technology. And that really does speak to that continuing demand that we see that also translates into the CapEx plans, because I'm just taking a look at 2025 CapEx. It's just dropped as well. That's between $38 to $42 billion. The estimate had been for $35 billion. So they're continuing to spend in this vein as well. So lots of commentary that's just dropping now. We do actually have a T-Live blog underway. So, of course, if you're interested, you can get more details from our reporters and editors that are also tracking this right now.
OK, Bloomberg Asia Tech reporter Annabelle Drewler's zeroing in on that CapEx number, and rightly so, in terms of the indicator around the confidence that TSMC has going forward in terms of demand, of course, for the chips that it produces, that major foundry owner, looking potentially at CapEx of up to $42 billion for 2025. Annabelle, thank you. Coming up, we're going to take a closer look at earnings for the banking sector. Big US banks reporting. There have been some superlatives around the banking earnings story. They close out, of course, the Biden era with a surge in profits. The details are next. This is Bloomberg.
We've been hiring, across the businesses in areas that we want to grow while we get more efficient. And so generally that's in places, in client-facing roles across the commercial bank, the investment bank, our capital markets teams within our markets business, as well as in wealth management.
We believe it is our responsibility to continue to press for a more transparent regulatory process in order to foster a more efficient financial system that supports growth and competitiveness of the U.S. economy.
OK, Wells Fargo CFO Mike Santomassimo and Goldman Sachs CEO David Solomon, of course, both speaking after their earnings reports. 4 of the biggest banks in the US have now ended the Biden era on a high note, notching their second most profitable year on record. For more, let's bring in Bloomberg's Charlie Wells, who's been following all of the earnings story across the banks for us. Charlie, what is the outlook then for the rest of the year? What have we been hearing from executives?
Tom, I think CFO of JP Morgan, Jeremy Barnum, put it best yesterday when he said that animal spirits have returned to the sector. So there is so much optimism. There is this hope that M&A activity will pick up on one side. There's also this hope that rates might kind of play ball here and that they're headed down, but they might be headed down in sort of a slow and perhaps slightly more predictable pattern. And so that could be good on the deal side, but also good for that net interest income side, where you've still got some of those rates providing that revenue coming in on the lending side.
Yeah, it's really interesting. So arguably something of a sweet spot on rates for these banks, at least for now. We've heard a lot, of course, and you touched on this for us yesterday, around recent shake-ups in terms of the management of some of these top US firms. Let's take a listen now to what Jamie Dimon had to say about his own position at JP Morgan in the near future.
I do love what I do. I'll be 69 in March. I think it's just a rational thing to do. I've had a couple of health problems, I just think it makes a lot of sense.
Well, Charlie, Jamie Dimon has long been in the spotlight in terms of succession plans. When he steps down, he's long made a joke of being 5 years down the line. Is this Jamie Dimon finally kind of putting his finger in the air and saying, you know what, it's time for me to think about stepping down?
This was one of the people questions that really kind of loomed over this week. It came into the spotlight before the earnings were announced because the bank, JP Morgan, announced that COO and President Daniel Pinto would be retiring at the end of this year, that Jen Pipsack would be named to the COO position, but does not, at least at this time, want to be the next CEO. And I mean, look, Dimon has been at the head of this bank since before the iPhone was invented. So it's been a really long time.
Wow.
He's turned it into the country's largest bank. And I think it's just difficult because he is such a figure in this industry. There was, of course, that joke about, 5 years more that he would stay. He told investors in the middle of last year that time frame had changed. And yesterday, during the earnings call, he talked about how, there are candidates that the media, that analysts may know about. There may also be one or two that they don't know about. So a little bit of, kind of building suspense there and kind of adding to some mystery. But this really has been one of the biggest questions of the week.
OK, and it suggests that this story is going to continue to fascinate, isn't it, in terms of the succession plans at JP Morgan. Meanwhile, Citi, I believe 3 out of their 5 main units had record revenues. And yet, it seems they are looking at job cuts. What's going on?
Yeah, they also announced $20 billion in share buybacks, but they are in the middle of a turnaround. They've been talking a lot about implementing new technology and trying to, be more efficient. That tends to mean layoffs. So they said that they are going to be earmarking $600 million for severance payments. Of course, that comes with layoffs. That's a little bit lower than what they had last year when they slashed 10,000 jobs. Management had said that as part of this turnaround, they want to cut 20,000. So we've got 10,000 left. It looks like we kind of know what that means about the year ahead. Potentially layoffs.
Okay, potentially more layoffs at Citi. So the pain point there. JP Morgan, I love that time frame. Head of the bank, or at the bank, since before the invention of the iPhone. Bloomberg's Charlie Wells on bank earnings, and we've got more big numbers dropping, of course, in the banking sector later today. Charlie, thank you. Coming up, President Biden makes his farewell address. We bring you that story and a roundup of some of the other news we are following. That is next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Other stories making the news this Thursday. President Biden has delivered his farewell address from the Oval Office, listing his achievements over the past 4 years, while also voicing concern about the future of the US. The president said he worried about the consequences if wealthy Americans use their influence to win tax breaks or roll back efforts to combat climate change.
I want to warn the country of some things that give me great concern. And this is a dangerous and that's a dangerous concentration of power in the hands of a very few ultra-wealthy people. And the dangerous consequences if their abuse of power is left unchecked. Today, an oligarchy is taking shape in America of extreme wealth, power, and influence that literally threatens our entire democracy, our basic rights and freedoms.
Meanwhile, Bloomberg has learned that Canada has drawn up a list of $105 billion worth of American goods that it would hit with tariffs if President-elect Donald Trump imposes levies on its northern neighbour. Our source says the list will only come into play if Trump moves first and may be expanded later, depending on what the US does. Hindenburg research founder Nate Anderson says he is shutting his short-selling firm, famous, of course, for targeting billionaires Gautam Adani, Jack Dorsey and Carl Icahn. In a post on the firm's website, Anderson says there is no specific threat, health or personal issue behind the decision. He says he now views Hindenburg as a chapter in his life, not the central thing that defines him. Let's check in on the Asian markets right now. Getting a lift, of course, from the risk-on sentiment we saw towards the end of the Wall Street session when the Nasdaq 100 gaining more than 2%, the S&P rallying close to 2% as well by the end of the close, up 1.8%. That handoff has been felt in the Asian markets, but also the earnings come through from TSMC, giving a lift to some of the chip companies and chip providers, some within the ecosystem benefiting, given the very solid numbers coming through from TSMC over in Taiwan. Broadly across the AAS, MSCI Asia Pacific, the broad benchmark across that Asian region, you're seeing gains of 0.9%. In mainland China, the CSI 300 is now up 0.2%. And in Japan, the Nikkei gaining 0.5. Again, some of its chip makers, equipment makers, are benefiting on the back of the blowout numbers coming from TSMC. That index now up 0.5%. The Japanese yen in focus, the Bloomberg scoop around BOJ officials now edging closer to another hike next week at that monetary policy decision for the BOJ, and the yen gaining 0.2% against the US dollar, currently trading at 156. Coming up, traders are back to fully pricing in a Fed rate reduction by July following the US inflation report of yesterday. We're going to speak to Sunaina Haldea from Raymond James about how to think about a more benign inflation picture in the US and how to position. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Israel and Hamas agree a ceasefire. It will begin on Sunday and last initially for 6 weeks. The deal includes the release of 33 hostages, while Israel will withdraw from populated areas of Gaza. Risk on returns. Cooler US inflation sparks a global rally, with Asian stocks tracking gains on Wall Street. In Japan, BOJ officials see a good chance of a rate hike next week. We bring you our scoop. And a holiday surprise. Richemont sales jump 10% in the latest quarter, with the US and Europe driving earnings at the owner of Cartier. The earnings story then in focus for us today, but it is still the adjustment of these markets around a softer inflation print out of the US, with yields falling yesterday by about 15 basis points on the 10-year. Currently, European futures turning positive, now pointing to gains of 0.2% after a solid session for European stocks yesterday. Part of the upside will be coming through on the back of the numbers from the likes of Richemont, and in the tech space as well. The semiconductor foundry owner TSMC beating and looking very strong in terms of the demand outlet for 2025. On AI. FTSE 100 futures pointed to gains of 0.2%. S&P futures, after rallying 1.8% yesterday, the best day since the election, the re-election of Donald Trump, now looking to gain 0.1%. Nasdaq 100 futures, which rallied more than 2% by the end of the close, now looking to add 32 points. Let's have a look at the Treasury story then, and the yen on the back of the BOJ reports, because you have, of course, seen some pretty significant moves into Treasuries along the curve yesterday. Today, stabilising at 4.65 on the 10-year, 122 on the pound. Sterling under pressure again, down 0.2%. Brent trading up 0.2 at 82.17, and Bitcoin closing in on $100,000, once again up 0.1%. Returning to our top story, though, in the geopolitics of the Middle East, Israel and Hamas have agreed to a ceasefire deal in Gaza that will take effect on Sunday. It pauses 15 months of fighting that has killed thousands of people and caused widespread destruction. But it is a fragile reprieve. The conflict has left Israel's enemies across the Middle East reeling. Let's get more with Bloomberg Horizons anchor Jumana Pasechi, who's in Dubai and, of course, has been following the story for the last 15 months in detail. Jumana, what do we know about the deal and how likely it is to lead to a permanent ceasefire?
Yeah, well, Tom, this is a moment that many in the region have been waiting for. As you say, the conflict going on for more than 14 months, 15 months of conflict, and several attempts to get one of these ceasefire deals across the line, as we saw over the course of the summer. But with many false starts. This time around, the ceasefire deal actually has been agreed to, as per a statement put out by the Qatari Prime Minister yesterday. He gave a press conference alongside statements from the U.S. Both President Biden and also President-elect Trump should be noted. But in terms of the deal itself, what we know about it, it is in many respects very similar to the initial Biden proposal that was put forward in May of last year, involving 3 phases. Phase 1 is known as the humanitarian phase, that would allow for the release of 33 Israeli hostages, some of them thought to be dead and thought to have died in captivity, but those will be elderly, children and women in exchange for Palestinian prisoners. It will also entail the huge upsurge in humanitarian assistance and aid that is necessary in the Gaza Strip, with about 9 out of 10 of the population living in a state of acute poverty. It also entails IDF withdrawing away from the inside of the Gaza Strip towards buffer zones, and then also allow for the return of many of the displaced civilians from the southern part of Gaza Strip to the north. So all of that was agreed to, but it should be noted that the second phase of the deal is likely to prove to be a little bit hairier because of the nature of what is to happen. First, Israel has said that they will not fully withdraw from the Gaza Strip unless there's a full release of hostages. Hamas would like to retain authority and governance in the Gaza Strip. But of course, this is a point that Israel will not agree to, and neither is the international community. The U.S. and Arab states are not inclined to want to see Hamas want to govern the Gaza Strip in the future. The third phase of the deal, if we indeed get there, is the reconstruction phase of Gaza. And again, that question about future governance. So still a lot to get to. But what we do know is phase 1 has been agreed to. It puts an end to the bloodshed. But questions still remain about the longevity of this deal and whether it can actually lead to a permanent cessation of hostilities.
What is the expectation, Jemana, that Netanyahu can get this through the Israeli government? I mean, we talk about Ben Gvir, we talk about Smotrich. These are right-wing members. I mean, we talk right-wing. There's right-wing and then there's right-wing. I mean, they're extreme right-wing. And they've come out and they've scuppered previous deals, or certainly they've had a role in it. Can you get it through government with them opposing this?
Yes, so the Israeli government is going to be voting on the deal today. The expectation is that it will pass, but with some very vocal opposition from the likes of the National Security Minister Ben Gvir, who you just mentioned, who, by the way, not so long ago actually told everybody that he was responsible for scuppering the initial attempts at getting a ceasefire deal across the line over the course of the summer. He does not want to see Israel and Hamas come to a ceasefire deal. There was also an equal amount of resistance coming through from the finance minister, Smotrich. But in the end, it seems as though there is going to be enough support from even opposition lawmakers within the Israeli government to get this deal across the line. There's a lot of public pressure. Many of the families of the hostages have been waiting for months now to see the release of their family members. And there have been many demonstrations calling for an end to this war. So the public pressure is there. But then, of course, you have to take into consideration the American pressure that has been applied, not least coming from the incoming Trump administration. And a lot of the credit actually is being given towards Trump and his team. His Middle East envoy, Steve Witkoff, was in the region the last couple of days, really pushing to get this across the line. And given that he steps into office on January the 20th, you would want to think that going forwards, it is going to be important for the longevity of this deal that the U.S. itself has thrown its support behind it. And therefore, the support of Trump and the fact that he feels some ownership towards it is going to be crucial in the coming months.
Yep, that pressure seemingly has not been insignificant, has it, coming through from the incoming Trump administration on this deal. Bloomberg Horizons anchor Jemana Pasechi, thank you very much indeed. The December reading of US inflation, meanwhile, switching focus, rose by less than expected, of course, igniting the best CPI day for the equity markets since 2023. The core consumer price index increased 0.2%, marking the first step down in 6 months. Let's get more on the market reaction and pushing out into the rest of the year. Very pleased to say I'm joined by Sunaina Haldea, Global Head of Private Capital Advisory at Raymond James. Sunaina, thank you very much for joining us in the studio. So we've seen a reversal in terms of the mood and the sentiment across these markets. Even European futures now pointing to gains after a solid day yesterday. The inflation bump seems to be out of the way, at least for now. And then on some metrics, the earnings story, whether you look at the banks or luxury space today with Richemont, seems to be a catalyst as well. Are we past, was the last few weeks, the start of the year, the wobble that we've seen in these markets on high yields, is that now in the background?
I don't think it's in the background yet. I don't think we're out of the danger zone when we look at the rest of 2025. However, I think it's a reprieve. For how long? Let us see. The earnings season is just off to a good start so far. If it continues to hold up, we'll certainly have the equity markets having more rallies. However, there is as much downside as there is upside given where equity, especially U.S. equities, are today. So I think the volatility story continues. Do we have a reprieve? Yes. For how long? To be decided. I think that there's risk there that the Fed is on pause. There's also risk that the Fed might hike in 2025 if the picture remains volatile on the CPI story. Great print yesterday. Remains to be seen for the rest of their quarters.
You haven't taken that off then in terms of potential outcome. You haven't removed completely the idea that the Fed could in fact hike this year, despite the more benign picture we've had on inflation this week.
It is hard to think about a zero hike situation. Is it a low probability? Yes. Can you put zero on it? No. Why? Because we have inflationary stimulus coming online, whether it's fiscal stimulus from tax cuts under the new administration, whether it's inventory levels, and finally, whether it's tariffs. All of those have to be then juxtaposed against productivity gains. The U.S. markets are incredibly productive right now. The labor markets are very resilient. So these are all in the balance. It depends on which way we fall. It's hard to take anything off the table given where we are today.
Is it as good as it gets for the U.S. dollar, do you think?
It is as good as it gets for the U.S. dollar with some upside, but a lot more on the downside. So a strong dollar creates lots of issues around the world. I think we're about to see the effects of those in some emerging market countries. However, we're at the peak picture, if you will, as we speak, unless we think about a hike further on down the line.
How are you thinking about the yield story then? Is 5% and above on the US 10-year a cap on the earnings story, or in fact the equity story in terms of the rally that we've seen? Is that a natural cap given the risk premium, or do you see buyers coming in and giving some pressure relief on that front? How concerned are you about 5+% on yields for these equity markets?
5+% yields for equity markets is a bearish picture. There's some that will say that actually you don't know why yields are going high. It could be going high because of productivity gains and so forth. However, putting that to one side, because that is the great unknown, it will put a bearish pressure on equity prices. So seeing a reprieve in yields has been welcome news for the equity markets. But I think it's not just I think what we're seeing with the volatility in the last few weeks is not just about the Mag 7s anymore. The 493 have to perform as well. So does the FTSE, so do Euro stocks. And I think that unless those earnings good news comes through, it's hard to see how you will not have a volatile picture around equities, regardless of yields.
Do you think earnings expectations are still looking stretched at this point?
They're looking very full right now. How does it listen in terms of guidance for this quarter? I think people feel like this is good news. There's more good news coming online that will help ease up the markets. How does it paint the picture of the back half of the year? That I think we still don't know. That's an unwritten story, depending on tariffs, depending on inflationary pictures. When
you're a private wealth advisor, what do you say to your clients when they ask you about the UK? How much exposure do you advise getting any exposure to UK assets?
Two sides of a coin, right? On the one hand, here's the good news. On a relative basis, UK, perhaps Italy, looking like the most stable political stories in Europe right now. When you compare it to Germany, when you compare it to France, it is, at least we know what the future from a political and macro stability perspective in the UK looks like. You can price that. However, on the flip side, as I'm sure we've all discussed here ad nauseum over the last week or so, it is looking incredibly tough on the fiscal side. This budget has been a very, very disastrous one when it comes to businesses, when it comes to the bond yields, when it comes to thinking about confidence in the UK economy. Stagflation risk with the CPI print has been put off the table for now. Will it come back? There's a real risk of that, and which is why you've seen yields ease about 14 basis points or so. But certainly there is risk that it pops back up if we have another down.
Our economists see 100 basis points of cuts now this year from the Bank of England. Does that seem a stretch to you or realistic? And if so, is there a catalytic effect for UK equities on that?
Probabilistically, can we get up to 100 basis points? Absolutely. How can we derail that? Well, we can derail that when we see inflationary breakthrough coming from the budget later on in the year, the second quarter, April onwards. And, of course, no one knows what the Trump tariffs and those pressures are going to be on this economy.
Well, how do you advise your clients around Trump tariffs? What is the Trump tariff play at this point? The Trump tariff hedge or the Trump tariff opportunity?
The Trump tariff play right now is this, from all the signals so far, that it'll be a gradual leg into it, that they won't go full steam ahead day one. So you have time to plan for it. However, depending on how much and on what country, that's how you might want to think about the equity story of that market. So, for example, thinking about globally diversified stocks, they'll stand you in good stead. Stocks that are interest rate resilient, those will stand you in good stead.
Sunaina, thank you very much indeed. Always really appreciate getting your analysis and your views in terms of how these markets are shaping up and how to think about the weeks and quarters ahead. Sinha Haldea, Global Head of Private Capital Advisory at Raymond James, not taking off a hike from the Fed off the table. Still a probability, small, but still a chance. And equity estimates in terms of the earnings story maybe looking a little rich at this point. Now some other stories making the news this Thursday. The Royal Institution of Chartered Surveyors, RICS, is warning that the UK housing market is facing a significant headwind due to elevated government bond yields, of course, which took a move lower yesterday, which could impact buyer interest in home sales. RICS says the number of market appraisals fell to its lowest in a year, and property surveyors have scaled back expectations of home sales and supply. Bloomberg has learnt that Hong Kong is said to be exploring options to raise taxes on top earners for a second year. Officials are looking at increasing the 16% rate for people earning more than 5 million Hong Kong dollars or lowering the threshold for the highest tax bracket. Coming up, Richemont sales jump by double digits as consumers splurge on the Swiss luxury firm's Cartier products. Details are next. This is Bloomberg. Welcome back. It is earnings season. Let's bring you some details around the luxury space right now, because Richemont sales unexpectedly jumped by double digits during the holiday shopping season. This as consumers splurged on the Swiss luxury conglomerate's Cartier products. Bloomberg's Angelina Rascouet may have been one of them and has the details. Angelina, thanks for joining us. Top line, very good numbers coming through from Richemont, defying those who are kind of wringing their hands about pressure on the luxury space. Strong results. What are the details? What numbers stood out to you?
I mean, overall, as you say, hi Tom. Overall, the numbers were very positive. It was sales were up 10% on the quarter. The most impressive performance was probably from the jewelry maisons, as they call it. So that's Cartier, Van Cleef, Buccellati. They were up 14%. The market was expecting, a gain of 4%. So that was really outperforming. So it shows you the strength of these brands, the desirability that they have, and also what was very interesting is that the watch segment that had been struggling for a while was still negative, but much less than expected.
We're showing some of the watches right now. I mean, they have IWC is one of their businesses. I can't get enough of these watch pictures. They're beautiful. What about the geographic picture, Angelina? How did it break down? We know China's under pressure. What about the rest of the world?
Yes, indeed. China continues to be a drag. It was down 18% actually on the quarter. But overall, Asia Pacific was down less than expected. But really, the impressive results were driven by the Americas and Europe, up by more than 15%, both of them. In the Americas, we can suspect that, this is the last quarter of the year. This is the holiday shopping season. This is when people splurge for Christmas gifts, and it was very interesting because also it came after the US elections, and typically that's what people have said, that generally in luxury people are maybe waiting for the results of the election, and once the elections are out, once the uncertainty is out of the way, they start spending again. So this is potentially what we saw. In any case, remarkable performance overall.
And you cover the broader luxury space. Is Richemont a tell about what is happening more broadly in luxury, or is this a very company-specific story?
I mean, it's a very resilient company, and typically in times of uncertainty, hard luxury, so jewelry tends to do better because the items are less. They're more timeless. They're less trendy. So I don't think we can apply this for the rest of the sector. At the end of January, we will have the results of LVMH. LVMH is more exposed to soft luxury, so that's handbags. They do own Tiffany, they do own Bulgari, like jewelry watches, but overall their strength is Louis Vuitton. So we'll see how Louis Vuitton has performed. But earlier this week we got a result from Brunello Cucinelli, which is ready to wear, but really high-end ready to wear. They sell you bomber jackets that cost more than 17,000 euros because they're made with cashmere and vicuña. So that one also showed that it's really, really resilient.
Okay, $17,000. $17,000 for a cashmere jacket. All right, Bloomberg's Angelina Rascouet, thank you very much indeed on the blowout numbers from Richemont, what it tells us about the broader demand for a luxury. To the mining space right now, Rio Tinto, the world's top iron ore exporter, says shipments slipped in the fourth quarter. This is back to the China story as well. Demand from China remaining lackluster and lower production at some of its mines. Copper production, though, surged 26% as Rio mined higher quality grades at its operation in Chile and continued to ramp up output from Mongolia. NBC is reporting that President Joe Biden's administration is exploring ways to keep TikTok available in the US if the ban takes effect. The app is set to go dark in the US from Sunday unless it is sold by Chinese owner ByteDance. Meanwhile, according to the Washington Post, President-elect Donald Trump is considering an executive order suspending the looming US ban. The Post cites unnamed sources saying a Trump order could suspend enforcement of the law for up to 90 days. There's plenty more coming up. We're going to give you a preview of US retail sales and UK GDP as concerns continue around the health of this economy. Stay with us. This is Bloomberg. .
all, this is not an inflation-prone economy. I mean, the economy left to itself is just chugging along, steady growth, a little over 2% growth, unemployment very steady, and inflation gradually coming down. So, the economy itself looks pretty good right now.
We're not going back to 0% kinds of normal rates, but rather those low single digits. Is it 2% or 3.5%? It's someplace in there, and we're moving into that range.
If you look over the last 3-4 months, we're basically running at around 2.5%. Which is where the Fed thinks we'll be at the end of this year for the core PCE. So by the Fed's own admission, inflation is stuck around 2.5%. And then also on top of that, the labor market seems to have stabilized. And that was the primary reason they were cutting. So we don't see any reason for them to keep cutting now going forward.
OK, some of our guests weighing in on the latest US CPI data and its implications for Fed policy. Of course, core CPI came in at 0.2%. Below the estimates, and markets now fully pricing in the next cut from the Fed in July of this year, with some betting that maybe they go as soon as March. Talking of the health of the US economy, we get US retail sales data later today. Bloomberg Economics expects a pretty strong picture. They actually expect a number of 0.9%. The overall estimate, though, is that retail sales will increase 0.6%. It's the holiday season, of course. A couple of factors that Bloomberg Economics have pointed to in terms of some likely strength in terms of the US retail sales. Holiday shopping season, of course. Stronger car sales is what they point to. People buying those cars ahead of concerns about tariffs, and a stabilising jobs market. So another gauge in terms of the health of the consumer in the US and what that tells us about the outlook for that economy. Talking of the economy, let's flip the board and have a look at what it means, all of this in terms of the UK. There's been great focus and scrutiny, of course, in terms of where the UK is going to find that growth that so far has avoided us. We'll see if any growth comes through in the latest numbers that drop at 7 a.m. UK time. We're going to get the GDP print. The expectation is that for the November print, you're going to see an increase, in fact, of 0.2% after that contraction in the previous month. Of course, this is a government looking for the fastest growth in the OECD. We are a long way from that. Let's see what the data tells us at 7 a.m. UK time. Inflation in the UK, of course, looking a little bit more benign yesterday, and you saw that move into gilts on the back of that. We're watching a launch, potential launch at least, of a Blue Origin spacecraft. The New Glenn is waiting in Florida. We keep across that story for you. The Opening Traders next. This is Bloomberg.